looking at companies like Pabrai, they were trading at north of 10 times revenue. So forget profits, these guys were burning cash actually, and you know, that's not the only thing they were burning. Hey. Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. Today it is very dark and gloomy outside and it's hosing down with rain, so I hope I hope the lighting's not too bad here, and I hope that the rain isn't messing up the audio or anything like that. So bear with me there, I apologize for that. Today what we're going to talk about is the perils of trying to get rich quick, and some of the dangers and potential consequences of trying to invest in these high-flying stocks, the really super high PE stocks, hyper growth, you know, potentially very overvalued companies, and what that can do to your returns. And I want to argue the point that it's actually a lot simpler to try and get rich slowly, as it were, and although that doesn't sound quite as exciting, it's definitely much more reliable, and you can actually perform a lot better over the long term than people trying to chase growth, trying to chase extremely high valued companies and ride the wave, as it were, of these, you know, high flying stocks. So let's get into some points around that, and I'm really keen to hear your opinions on this video in the comment section as well. So please drop any comments down below that you might have. Have you got experiences you know, getting burnt by some of these high flying stocks and that sort of thing, and what's your sort of opinion on this topic? Really keen to hear that. So let's get into the video. So Warren Buffett's core tenet of value investing is don't lose money, and I might even throw in a quick clip of Warren Buffett's first ever sort of TV interview where he says don't lose money. That's basically the key to investing.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
That's, you know, rule number one, as it were, and rule number one is what Phil Town picked up and wrote these sort of 3 books on. Rule number one, don't lose money. Essentially buy something for far less than it's worth. And then on the other side of the equation, you have guys like Peter Lynch and also Phil Fisher, who look to buy companies with a lot of growth, and they basically want to sit back and watch their investment grow over time. But something that people often miss is that Peter Lynch and Phil Fisher still pay attention to value. They still don't want to overpay for a company. They can definitely afford to pay a little bit of a premium compared to a company that's not growing, and still do quite well because the company is growing over time. It will produce more cash as time goes on, all going well. So, you know, in my books, growth and value are basically the same thing. If a company is growing, it has a higher intrinsic value. If a company is not growing, it has a lower intrinsic value. And generally speaking, it's better to invest in these growing pies, as Mohnish Pabrai might put it. But I'm going to run you through some examples of where trying to chase growth to too large an extent will get you into trouble and has gotten investors into trouble before. We're going to talk through a few sort of historic bubbles, and then I'll pop up some stats on how this can actually kill your investing returns over time. So let's run through some of these examples. So the reason Warren Buffett preaches rule number one, don't lose money, is basically due to some simple maths. And that is that if you lose, let's say 50% on an investment, so you have a $1,000 investment that goes down to $500, you don't have to make 50% to get back to your original amount of principal. You actually have to make 100% return. So if you're now sitting with $500, you have to double your money to get back to that original 1,000. And that is something that can really kill returns over time. Compound interest, as Einstein put it, is the 8th wonder of the world and will make you very, very rich if you can have it work in your favor consistently over a long period of time. But it's one of those things that is extremely difficult to make up ground on again and catch up on. So have a look at this screenshot. This is an example of $1,000 invested over a period of 10 years. And in the first example, we're going to take a market average, a reasonably conservative actually, market average rate of return of around 7% per year for 10 years. And then we're also going to have, in the second example, someone chasing these high growth stocks and doing quite well for the first few years, making 10% a year, but then having a sudden 60% drop halfway through that decade, and then still continuing to make 10% after that. And you'll see that the 50% drop absolutely kills the returns over time. And that person that was massively outperforming the market originally is now not doing quite as well. So we don't want to lose money, and in my books, that is something that you should actually be focusing on a lot more than the potential upside. So you want to invest in things that have very little downside, even in the worst case scenario for that business. They're not going to lose money, and they're priced at a reasonable value, even if they have quite low growth compared to what they're expected to maybe do. And if you can invest in those types of situations and the company does perform poorly, you're probably not going to lose money, or you're at least not going to lose a huge amount. And if the company does well, then that investment is going to grow over time and you're going to perform phenomenally. So next thing I want to touch on is some bubbles that people have been caught in, and I want to really use these bubbles to stress the point that the things that these people are investing in may be genuinely fantastic businesses, but price does matter. No wonder how wonderful a business is, it's not worth an infinite price, and that's a quote from Charlie Munger. And here's some examples of where we've seen that in the real world. A few of these are quite old and some are very, very recent, so pay attention. So the first two bubbles here are something that I would like to put in the category of what I call pure speculation. And this is a type of investment where the underlying sort of asset that you're investing into doesn't have any underlying fundamentals to it. So it's not a business that produces cash. When you have a business that produces cash, you can quite rationally value that cash. You can put a value on the business, you know how much cash it will return to you over time, and you can work backwards and figure out what the business is worth today. When we're investing in things that are non-producing, then we basically can't come up with an intrinsic value. It's all about supply and demand of that product at a certain point in time. So when we're looking at things like gold and silver, those types of sort of assets people put money into, but they don't actually produce anything. They don't produce cash, and they don't produce food like a farm might or anything like that. So they're very difficult to value, and it means that speculation can run wild when it does happen. So I'm going to put up a screenshot here of the first bubble we're going to talk about, and that is actually way back in, I believe, the 1600s. And that is around the tulip bubble. So the tulip bubble, yes, tulip the flowers, the tulip bulbs got so highly priced you could go out and buy a house with a tulip bulb. Ridiculous speculation, and that's sort of the first example. Following massive exuberance and speculation is almost always a crash. So if you're ever seen something about prices skyrocketing on the front page of a newspaper, that's probably a fairly good sign that you're getting towards the top end of that exuberance and that massive speculation. So next one is Bitcoin. So this is a controversial one. This is a very controversial one. So if there's anyone on the channel watching this that likes Bitcoin, I don't necessarily have anything against Bitcoin itself, or especially the underlying sort of blockchain technology. What I do have an issue with is people saying that Bitcoin's going to 100,000, Bitcoin's going to $1 million a Bitcoin, and all these things. And really nobody knows what a Bitcoin is actually worth. It's all about supply and demand, just like any other commodity. And, a Bitcoin doesn't produce anything. It's like gold doesn't produce anything, just like a rock on the ground doesn't produce anything. It's just a currency that people trade in, and there's arguments that that's not even the case for Bitcoin. But rather than diving into a whole kind of rant about Bitcoin, let's look at the Bitcoin charts. We saw people make ridiculous amounts of money, at least on paper, right through from basically when Bitcoin first started till about late 2017 off the top of my head. And then we saw around an 80% crash in the price of Bitcoin. And this is what happens when you have a pure speculative, basically, investment, as some people like to put it. It's not really an investment in my books, but pure speculation where there's no real fundamentals behind the thing you're investing into. It's literally you're just looking at the price. Cool, the price is going up, let's put more money into it. The price keeps going up, more people put more money into it, and this thing just goes out of control. Eventually the bubble pops and we have people lose a lot of money. So those are two examples of basically pure speculation. The next few I want to get into are what I call, they're still speculation, but they actually do have some underlying fundamentals. And in a lot of ways, these bubbles are actually more obvious. So if you have an idea of how to value a business and you see that people are just paying ridiculous prices for the amount of cash this business can reasonably produce, that's a bubble. And you can actually pick that up fairly easily. So let's get into some examples of that. So the first bubble, and this is an example of something that actually turned out to be a great technology for mankind, but you have to actually still pay a reasonable price regardless of how big an innovation this might be. And that is basically the internet. So if we look at the tech bubble, I'm just going to use the NASDAQ index as basically an indicator of all these technology companies. The NASDAQ is basically sort of the younger, cooler brother of the New York Stock Exchange, I suppose, where a lot of these technology companies are listed. And you'll see that around 1999, 2000, we saw huge increases in the prices of these internet companies. It was going to be, the biggest revolution since I don't know what. Basically, the biggest technological advancement of our day, and in a lot of ways it has been. Technology and the internet has changed everyone's life. I use the internet a million times a day, and I'm sure you do as well, but you've got to pay a reasonable price. And we saw companies like Yahoo trading at 2,000 times earnings, and if you actually take 5 seconds to do some reasonable maths on that, for Yahoo to get down to even a moderately low PE, like a 40 PE, which is still huge, then Yahoo would have to be producing basically the entire GDP of the United States as earnings. So that's an obvious bubble. That's not going to happen for Yahoo, and people are just paying too much for that business. Regardless of how well Yahoo does in the future or how well, Amazon turned out to do in the future, you are paying too much up front for that business, and you saw a lot of these companies go down 70, 80, 90, 100% even in the case where there were literally no good underlying fundamentals and the companies actually went bankrupt. So the tech bubble is a recent one that did actually have some fundamentals behind it. The second one, and a very recent one, is basically the cannabis bubble. So we see companies like Canopy Growth, like Tilray, relatively new companies, have a lot of speculation in the prices that these businesses are trading for. And it's yet to be seen how well these companies actually do over time. But a lot of them are trading at huge multiples of revenue. So, when we typically look at a company, we're looking at things like the price to earnings ratio, the price to book value or equity kind of ratios. If a company earns $100 in earnings, can I buy it for, say, $1,000 or a 10 PE? When you are looking at companies like Tilray, they were trading at north of 10 times revenue. So forget profits. These guys were burning cash, actually. And, that's not the only thing they were burning. Hey. These guys were trading at multiples of revenue. And the prices that you were paying for these businesses were just extreme. And it can be quite comparable in my mind to the car business. So I heard Warren Buffett actually speak about the car business in the early 1900s. There were a huge amount of producers of cars, and right now there are a huge amount of producers of cannabis, and there's a lot of companies getting into the cannabis space. And I have no clue which company is going to do best in this cannabis space, just like nobody had any idea that Ford was going to be the company to succeed in the car industry, and all the other companies basically were going to go bankrupt. So that's something to keep in mind. And again, you've got to look back at how these potentially high-flying, high-priced stocks can really influence your returns over time. In my books, if something goes wrong, that negative is far worse than the potential upside of things going right and hitting one out of the park, maybe 1 in 10 attempts at buying these high-flying stocks. So that's my opinion. For most people, I think, to be honest, the best investment strategy is just to buy an index and forget about it. That way you will steer clear of a lot of these high flyers, and you won't have the big negative years unless there's a huge stock market crash or recession. But in that case, you're able to buy more at probably pretty reasonable prices. So that's going to be basically a good thing for your returns long term. If you are going to pick individual stocks, there's really a couple of things that you have to do. You have to be able to understand the economics of the business. You have to understand, its competitors and what that business is likely to produce in the future. And you have to absolutely be able to value that business and buy it for less than it's worth. So that's my 2 cents on, trying to get rich versus trying to get rich slow. If you look at a chart of Warren Buffett's net worth over time, he's now worth about $80 billion. He didn't hit the first billion until he was 50. So even in Warren Buffett sort of land, he was getting rich slow, I guess, if you were to put it that way. By billionaire standards, he got rich pretty slow. So, unlike Bill Gates and Jeff Bezos and the people that founded these huge companies and made their fortunes in sort of 10 or 15 years or something like that. Buffett was investing for 30 or 40 years before he made his first billion. So that's my 2 cents on that. So hope you enjoyed the video. If you did, please hit like and subscribe. I'd really appreciate that. And as I said, I'd really love to see your comments down below, so please drop them there. You can hit subscribe over that way and watch extra videos over that way, and I actually think I got that the right way around this time. So I'll see you in the next one. Cheers.